Welcome to the Same Day Podcast, where we discuss driving incremental business growth and other topics related to real estate, property management, and entrepreneurship. Now to the show at hand.
All right. Well, we are extremely excited to be here, with Yoni Schmidt. Yoni, thank you so much for joining me today on this, what we hope to be a fantastic webinar. How are you doing this afternoon?
Doing well. Thanks, Josh, for having us and helping us put this together.
Yeah, absolutely. Really excited to share this with all of the contacts that you have. I know people are really excited about learning more about the Oklahoma market, and so we're going to really address Oklahoma City in Tulsa today, but we're probably going to hit on some other things that people are going to find really interesting, and so super excited to get going. So we're going to go ahead and get started. For all of you that are tuning in live, or for those of you who may be watching on a recording later, we really think this is going to be a tremendous masterclass in how to invest like a pro in the Oklahoma market. So we're going to go ahead and get started. Again, thank you for coming. If you got any questions, go ahead and drop them in the chat. If we have an opportunity, we certainly love to answer those. And then today, what we're going to walk through is a couple of things. One, we're going to review the types of lenders. Who is out there financing residential investment properties, right? Who is out there funding SFR deals? We're going to talk about a little bit about who LendingOne is. We're going to reintroduce, most of you are very familiar with Keyrenter, but we're going to reintroduce Keyrenter. We're going to talk about why some investors choose to put their properties into an entity name versus keeping them in their own personal name. Talk about the difference between DTI and DSCR loans. We're going to look at different investment strategies, or what is your avatar as an investor, and what type of profile you might have. And then we're going to talk about a few loan products that LendingOne offers, if that would be of interest to you. And then we'll end with a Q&A session. So first and foremost, want to just real briefly, as a co-host here, talk a little about LendingOne. So LendingOne is a direct private lender. We've been in business for this sheet's actually a tiny bit out of date. We've been in business for a little bit over 10 years. We've done thousands of loans. We've got about a 150 person team that's scattered across the Eastern Seaboard. We're headquartered in Boca Raton, Florida, but we have offices in Charlotte, North Carolina, and New York City. But we are a nationwide lender. So pretty much anywhere where you have an investment property, we'd love to be able to help out. We do a ton of originations to both new and repeat investors. And so we'll continue to talk a little bit more about our services as we move along. But my name's Josh Heintz. I'm the Vice President of Partnerships with LendingOne. Had the distinct honor to be able to be hosting this webinar, this informational webinar we hope you get a lot of value out of, with my good friend Yoni. And so Yoni, I'm going to let you take it away and reintroduce people to Keyrenter. So tell us, what do you guys have going on over at Keyrenter, and what have you been up to, and then how can you help your clients?
Yeah, thanks, Josh, for kind of kicking it over to me. Keyrenter PMC is really a part of the larger franchise of Keyrenter. Keyrenter, as you may know, a larger national brand that operates in about 86 offices. We currently hold 5 of those markets, but today we're only going to be discussing 2, Tulsa and Oklahoma City. And we've been in business for roughly 7 years. We're also a team of about 110 employees, many of them boots on the ground, and many of them are also remote team members that handle a lot of the admin work, proudly serving, as you can see, roughly 1,400 owners and managing just about 3,000 doors with that team. We serve, we have offices in Oklahoma City, in Film Row, in Tulsa near Cherry Street, offering services, as you can see, to both accidental and institutional investors, serving local clients out of states and globally as well. If you have any questions, we're here to help with any and all of your property management solutions. Our core focus is to help our clients build wealth by removing the headache of property management. We are, your same-day property management solution, tend to get back to people within 24 business hours, if not sooner. Of course, in case of emergency, a lot sooner. And our core focus and the 3 things I'd say that make us unique are The fact that we leverage technology in ways that other property management companies may not. We're hyper responsive and overly communicative, and we are ROI focused. We understand these are investments. That's why we partner with great lenders like Josh and LendingOne, and we understand that this needs to ultimately work for you.
Yeah, and one of the things that I love about being able to do this together, Yoni, is you guys help people from all over the place. And a lot of people, when they think about their property manager, they're thinking about just simply deferring a responsibility. But it's so much more than that. It's about, you have a team of 100 people that are hyper focused on the markets that you operate in. And so, you as the subject matter expert for any investment property in Oklahoma, I think is one of the cool things that we're going to be able to highlight today about, what are the secrets, right? What are the neighborhoods? What are the areas you really need to be focused on? And how do you invest in Oklahoma? Because I can tell you as a nationwide lender that lends in Oklahoma and in Florida and in Tennessee and in Texas and in Colorado, I can tell you every market is unique. Every market is a living, breathing, dynamic organism. And having somebody like the Keyrenter team that are those boots on the grounds that are hyper fixated on that every single day are going to give greater insight than if you're just Googling, from home, what should I be doing and where should I be going? Where should I be investing in? I think that's one of the really cool things about what you guys offer, because it's way more than just being a service provider. It's also being the market expert to help facilitate the growth of your investors towards their goals.
Yep. And Oklahoma's a hidden gem, I would say, that many people overlook. And it's easy to overlook because it's not as, sexy or shiny as investing in Florida or, California or even in areas like Texas. But there is a lot of opportunity in Oklahoma, and I'm excited to dig in and explain and showcase why investing in Oklahoma is such a great idea.
Absolutely. Love that. All right. So let's get into talking a little bit, Yoni, about who it is that funds residential investment loans. And so you're not just a property manager, you're a longtime investor yourself. And so you have a really unique viewpoint into what this means for investors. But the most average way is, hey, if you've got a stack of cash sitting in the bank that you're needing to do something with, I mean, look, money markets are great. They can give you a little bit of money. But you want to put those savings to better work. So this is probably where a lot of people start to begin their investment journey, as they say, okay, well, I've got a few dollars laying around. I got a little honey hole, stored. So why don't I put that to work? And so a lot of people start there. And then some people, for better or for worse, also jump into the friends and family camp. Now, Yoni, I don't know about you, but Thanksgiving dinners can be a little bit weird if you've got a lot of money laid out with a family member across the turkey from you.
Yep. Yeah. I personally have sacrificed growth myself to avoid using OPM, right? Other people's money. And I have generally tried to, leverage my own money. I'm okay losing my own money and risking it. I don't want to be sitting across from, a sibling, a parent, a cousin, or someone at Thanksgiving dinner and tell them that I've lost their money. That would be very, very embarrassing. So, I have sacrificed growth, but I've seen people do it, and it's, they can be very successful in it. You just have to do it in a diligent, calculated, and very well thought through way.
Yeah, absolutely. And so as we all, what you'll hear Yoni and I say throughout this is you need, as an investor, you need multiple tools in your tool belt. And if this is a tool that works for your tool belt, all the merrier. That's fantastic. We're just going through the different options. So the other one is probably the more traditionally understood, local banks. And so for the purpose of this conversation, when we discuss local banks, what we're referring to are both your community bank, so Main Street bank down the road that everybody knows to, that's local to your community, maybe has a couple of branches. We're also talking about the Wells Fargos of the world, the Chase banks of the world, your credit unions. So when we talk about banks, we're really talking about any type of depository institution. where you can go and open a checking account or a savings account. Any type of bank like that is what we're referring to as a bank. And they've been around for the longest time. They're tried and true, and we'll get into where they provide a lot of value here in just a moment. And then the last group are that fall in the specialized lending camp. And so when we talk about specialized lenders, for the purpose of this conversation, again, what we're really referring to are three different groups. Group number one is what's considered like real hard money. So when you hear the term hard money, people have varying definitions of that, but what we're talking about is typically going to be a high net worth individual that's in your area, that's very local to, 123 Main Street down the road. They know exactly where that property is. They know what it's worth. They know why you want to buy it, how you're going to get it fixed up. They're hyper local. Then you also have the second are small family offices. So this may be somebody who is aggregated funds from their friends and family, and they may have a pool of 10, 20, 30 million dollars that they're looking to put to work. These are typically on short-term basis. They want to fund things like fix and flips because they can get in and out of that really easily. So individuals, small family offices, and then the last are what LendingOne falls in the camp of, which are referred to as direct private lenders. These are larger institutions that usually have a much broader scale than just being locally fixated on something. Typically, they're going to have a more diverse group of products that they can offer to their clients. And so what does all this look like, right? When you have all of these different options, you're open up then to looking at the difference between a bank, a hard money person, or a private lender. And so, we look at these couple of different groups of categories, things like speed of funding. How quick can you get your money? What's the rate going to look like? How much paperwork are you going to be tied up in? Do these people actually focus on investors? And do they require an entity for you to close? And so there are a couple of different ways. First up is banks. And Yoni, look, forever, banks have been the go-to for people going and getting into lending. But look, we know that they're going to be premium when it comes to favorable interest rate, but the rest of it kind of falls a little bit flat sometimes.
Mm-hmm. Yeah, I mean, banks do require a lot of paperwork and information. One of my least favorite things to do is put together the personal financial statement, which I know almost every lender is going to end up asking for at least once a year, right? So that's why it's best to always also have a great CPA who has your books in order, so that you can just in an email and say, please send them my tax returns for this year. Having your team in place is extremely important. That's when you need your property manager to send over a cash flow statement or a rent roll, right? To continue the relationship with the bank, so that you can, or your private lender, of course, so that you can continue to grow and leverage your resources and continue to buy. As far as like requiring an entity, there's of course a risk there, not having an entity. Some of my properties are in an entity, some are not. I'm more exposed on those that are not in an entity, and I'm less exposed on those that are in an entity. But it also means that there's a little bit more work on the ones that are in an entity, and I have to follow those rules and guidelines and regulations to ensure that no one can truly come in and pierce that corporate veil.
Yeah.
Good slide here.
Yeah, and those banks, they are they're notorious for, if you bring up, hey, I'd love to close this thing in the name of my entity, a lot of times you're going to get a little bit of pushback. So some of the values that you see in banks are typically going to be, at the end of the day, the reason people go to banks is, one, because of familiarity. They know the process. When they walk into a bank, they know what that's going to look like, and they're typically going to have good interest rates. Then you got on the other side, you've got your hard money guys who are, again, those local high net worth individuals or family offices, and they're going to be able to get you that money really, really quick. I mean, effectively, they just got to know that in the event of a default, they're going to be able to retain that property. And so they're going to put the paperwork together for that. They don't need to see a lot of different paperwork to get that thing started. They're going to be very focused on investors. Now, for them, typically, you're going to pay a little bit more. And so, because look, there's always this balance, right? You're going to, the pain that you take on for dealing with a bank, the value is you get the favorable interest rates. But on the other side of that, if you're going with somebody on the hard money side, you're probably going to forego those favorable rates or the lower cost but you're going to get that money really, really fast. And if you need it, and they're going to be, look, if you might can have a 550 credit score, and somebody with a hard money is going to come in and say, hey, that's okay, we can work something out, where other options are not really so much going to be there. And then, not to paint such a rosy picture that private lenders solve all of these problems, but we do like to say that we're a good bridge between the world of banks and hard money, because we can also fund transactions very quickly. We typically have, and we'll look here in just a second, how our interest rates typically stack up versus other entities. Limited paperwork for us, very much so, obviously focused on investors. Now, one of the things that is unique to us that you can see here is, we do require somebody to close in the name of an entity. And so when people think about that, oftentimes they get a little bit of pause and they think, okay, well, why would I ever put my property into an entity? And Yoni, we just talked about it a little bit, but what are the different reasons? I mean, the first is, and I think probably the most intuitive, and before we go on to this, I would like to say neither Yoni or I this is not legal advice. We are not, tax attorneys or consultants. This is for educational purposes only, based on our opinion. But you do this every day. You see what can go wrong with a property. And so the number one thing that people should really consider when they're thinking about putting their property into an entity is liability protection. No?
Yeah, definitely. I mean, I've seen major lawsuits, six-figure lawsuits, that have been filed against homeowners and landlords for whatever reason. I mean, one of them, most recent that can come to mind, is a tenant fell through a deck and had to have some surgery and a lot of medical expenses related to that. And that's a big risk for a landlord. So having that having your property in an LLC, which thankfully this owner did have it, protects you, the landlord, and the investor from them being able to come after you personally. And they can only come after the assets that are in the entity, which is a good way to protect yourself. Again, there are certain things that you have to do. You have to keep annual meetings and minutes, and make sure that you're registered and you're in good standing and you're doing all the things that you need to do as an owner of an LLC, right? Because if not, then it will be very easy to pierce the corporate veil and ultimately get to you personally and sue you personally. So again, we're not attorneys. I'm not an attorney. I have no legal background or experience, very little and limited. Talk to an attorney, but that would be one of the main reasons, is liability protection.
Yeah, and the good thing is you can set these things up quick. And I know they can reach out to you. You can connect them with an attorney. They can get that done in moments.
We can even do it for our clients. We can be the registered agent for our clients in all of our markets. We can start the entity. We have blanket, very, very, very good operating agreements that we're happy to share for free with any owner who needs to open an entity in Oklahoma, in Arkansas, in Kansas, in Missouri. We'll do that for you. And, we'll, of course, there is a fee for it. It's not free, but it's what it costs, right? So if the state charges you $100 to open an entity, we will charge you $100 to open that entity. We're not going to dress it up like an attorney or a CPA would with, thousands of extra dollars. And I've done this time and time and time again.
Man, I love that. That's fantastic. So yeah, definitely reach out to Yoni. They can take care of you. Love to hear that. So the next reason is privacy. Look, at the end of the day, people pay property managers for a number of things, but a big part of that is they want anonymity, right? And so LLCs can also provide that additional layer because, look, I mean, if your property is out there in a simple Google search to find that it's in, Josh Heintz's name, how easy is that then to go to a skip tracing website and find my address and my phone number? And so putting that property in an LLC will provide an extra layer of anonymity between you and your tenant that may be in that property. And just like Yoni was mentioning, the separation of personal and business finances is both beneficial for the purpose of your end of year accounting, right? I mean, when you can hand that stuff over to your accountant and it's not mixed and blended with all of your personal bank statements, there's a lot of value in that. But you also want to make sure, as you mentioned before, you start commingling those funds, and then that piercing of the corporate veil is a very simple case for a good litigator to run through.
Yeah, that's an excellent point. If you deposit those rents into your own personal checking, it could be a lot easier for them to pierce that corporate veil.
Yeah, 100%. And then the last thing is this is going to qualify you for a business purpose lender like what LendingOne does. So one of the things that is unique about LendingOne, as well as we mentioned earlier with banks, banks will typically not want to close a loan in the name of an entity. Conversely, LendingOne will only close a loan in the name of an entity. Now, we do ask for a personal guarantor on every loan, but that loan is not closed in your name. And so you don't have to have your property in an existing entity to close with LendingOne. It just has to close in an entity by the time you get to the closing table. So that can be developed. And so, a lot of people look at this and they think, okay, that sounds cool, but why would I even care about that? And so we'll talk just a little bit about the difference between a typical conventional loan that you would usually get versus a DSCR loan. And so the most common loan that people typically get when they go to a bank is a debt to income ratio loan or a DTI loan. And so what they're doing here is they're using your gross monthly income to determine how much money you can afford, because these types of loans that you probably got on your primary home are being underwritten based on your personal ability to repay that loan. What a lot of people aren't familiar with, though, is this DSCR loan. DSCR stands for debt service coverage ratio. And this is very simply looking at the property's ability or the entity's ability that owns that property and their ability to use the income that property generates to pay its own obligations. And so the math is really simple. If you're looking at a DTI loan, they're going to take your total gross monthly income and they're going to divide it by the total amount of debt that you have to come up with your ratio. Most banks are going to cap that ratio at around 50%. DSCR, on the other hand, is a very simple calculation. We're simply taking your rent and we're dividing it by your PITI. If you're not familiar with PITI, that stands for principal, interest, taxes, and insurance. The things that we do not factor in to your debt service coverage ratio are your property management fees. We don't factor in things like the cost of maintenance, the cost of vacancy. So this is very simply, if you rent a property, can that rent cover the debt obligation? So for a DTI loan, they're going to want to see your W-2. They're going to want to see your tax returns. They're going to obviously put the loan in your name. It's going to be reported on your credit. And you got to make sure that you stay under that DTI threshold. Whereas with a DSCR loan with a company like LendingOne, we don't care about your personal income, because again, you got to think about this. We're underwriting this property based on the property's ability to repay. You personally, look, Yoni, you and I both know the average investor is typically, sometimes they can be cash poor, but asset rich, W-2 poor, but property rich, right? And so that if you go to a traditional lender, they're not geared to consider those things, where for us, we're not going to ask for your tax return because it doesn't really matter. We're not going to ask for a W-2 because it doesn't really matter. We're going to put this loan in the name of an entity, and unless you default on it, we're not going to report it on your credit, which opens up your personal credit to go and do other things that you want to do in your personal life. And so if you're curious about what that ratio is, we're looking at a minimum 1x coverage ratio. So for simple numbers, if you're going to get $1,500 to $2,000 in rent, if the principal, interest, taxes, insurance do not exceed $1,500 to $2,000, as long as that's 1-to-1. So $2,000 in rent, $2,000 in PITI, that is a 1x coverage ratio. As long as it meets that as a minimum criteria, we'll typically fund that. And Yoni, as we talk to people, they hear this and they're thinking, okay, I can put a property in my entity's name. It doesn't report on my tax return. You're using the property to underwrite it. Like, this has got to be crazy expensive. The truth is it's usually not. So to take a look at what that looks like, you can see at these charts here, the change in the DSCR spread over time versus a traditional mortgage. So if you were to go to your local bank, you can see here that this ebbs and flows. There are times where we're a little bit pricier. There are times where we're a little bit cheaper. There are times where we might be quite a bit pricier, and there's times where we could be quite a bit cheaper. So it ebbs and flows, but you can see right now the difference is virtually negligible for what we can do now. And so we'll take a minute and look at just real briefly some real world examples of our loan products. So we're going to take an example, Yoni. So this is we're going to take an average of a $300,000 purchase price. We're going to presume a 20% down payment. Now we're using the 1% rule, which God knows everybody would love to have now. It's not really familiar, but we're just using this just for illustration purposes. And these purposes and for these illustrations, we're not going to include taxes or insurance. But to give you an idea, if you were to go to a conventional lender today, you're probably looking at a principal and interest payment or an interest payment somewhere in the 6.86% range. Closing time on an investment-specific loan is going to average anywhere between 45 and 60 days, usually through a conventional lender. Origination fees may not be stated on the front end. They may be baked into your interest rates, but those fees are going to be somewhere between 1 and 3 points. And you can see here what that cash flow would look like. Now, if we were to take a LendingOne DSCR loan, you can see there we're about 13 basis points higher on the principal and interest. Our closing time on average is around 21 days. Our origination fees are going to be a little bit less, between 1.25 and 1.75 points. That's based on your experience as an investor. And you can see there the actual cash difference is about $20 per month. And then there's something unique. Yoni, one of the things that we've heard a lot from our investors nationwide and that everybody's familiar with is with the rise in asset prices and the rise in interest rates, it's a little bit tougher getting things to cash flow. And one of the unique capabilities that we have as a private lender is we have the ability to go out and create unique loan products. And one of those unique loan products is it's a 30-year fixed rate DSCR loan, but the first 10 years is interest only. And so for people that are looking at investment properties, they think, man, I love that property. I know it's going to appreciate over time, but I just can't quite make the numbers pencil now. This would be an example, apples to apples, of how that particular product may could increase cash flow. So you can see here on the interest side, for an interest-only loan, the interest rate's going to be a little bit higher, certainly. But you can see there the way that it's going to boost your cash flow. And this could be the difference in somebody choosing to buy an investment property and them choosing not to. And so the value in this, and the reason that we created this product, is because the average investor is either going to refinance or sell their investment property every 5 to 7 years. And so if this is an opportunity, or if this can be a product to help get somebody into a position in a market, in a property they want to be in, obviously rates are not ideal right now. But rates, look, it's the nature of history over the last 75 years in the United States is rates are going to go up and down. If you see an investment property that you can get into and you've got a product that you can use that will buy you 10 years to allow that property to cash flow, put money in your pocket while you can experience that appreciation, then at some point in the future when rates come down, you can refinance that, pull some of that equity through that appreciation out while you've been cash flowing. That could be the best of both worlds, Yoni. And I know you talk to investors every day that are trying to figure out, how do we make things pencil? And so this could be, it's not going to be a great fit for everybody, but it could be an option for people who are just right on the threshold and are looking for cash flow over everything else.
Yeah, I love this loan product for, properties that are in highly appreciating areas. Like you mentioned, you're going to step into that equity once you go to refinance. And, for people who can bite the bullet and hold on, you may not want to take the equity out if you can hold on, or if you need the cash to redeploy into other assets and continue to leverage to grow your portfolio. This is a great way to do it. When I look at this DSCR-IO loan, in my mind, I'm thinking, man, I'd love to get like 10 of these together. After the first 5 years, right? There's no prepayment penalty with LendingOne after the first 5 years. And then, you cluster all of them together and you put them on, a different type of loan product that isn't necessarily IO, and you're stepping into all this equity. So I would highly recommend this loan product for people who want to continue to grow right now in tough economic and, in a tough economic environment, and when, interest rates are a little bit higher.
Yeah, for sure. And, as we know, so a couple points, the couple points I would make. One, thank you for mentioning that so all of our loans do come with a standard 5-year prepayment penalty. We do have 3-year prepayment options. We also have no prepayment options. There's a slight adjustment to the rate when that happens. But yeah, absolutely. That's why we kind of peg it at about 5 years. Most people are looking to either refi or pull a little bit of cash out, sell, whatever it may be. So huge opportunity there. And the way that this loan product works, just so you know, is this is a fixed rate. So even though the first 10 years is interest only. What happens is if you were to just say, you know what, I'm just going to keep it as is and let it run its entire course, the first 10 years are going to be interest only, and then it's going to amortize over the back 20 years, but you're going to keep that same fixed rate. So worst case scenario, we see a Europe type interest rate situation pop up. And then, if rates are 14%, 10 years down the road, you can still hold on to this same rate and let it amortize over the back 20 years of that. So definitely an option. This is kind of what we wanted to show is there are options that are out there. And so, what we really want to talk about today, though, Yoni, are what's happening in the Oklahoma markets and what these investors need to know about what they're getting into. And so we're going to go ahead and kick it off with Oklahoma City, right? Everybody's familiar with Oklahoma City. You've got plenty of investors that are already in that market. But, a couple of things that we want to run through is, what do people need to know? And, strong market fundamentals are obviously always going to be the first thing that investors should consider when they're looking at a new market.
Yeah, I mean, I love Oklahoma City. I used to live in Oklahoma City, went to school in Norman at the University of Oklahoma. We have the Oklahoma Thunder, of course. And the theme, I'd say, of Oklahoma City is growth. It's a growth and stability market, right? There's great, the population, I think, is actually a little higher now than a million. It's probably closer to like 1.4 million. In 2025 so far, we've added roughly 18,000 new jobs driven primarily by aerospace, by biotech, logistics, around Tinker Air Force Base, the Amazon fulfillment facilities, great yields and, rising rents, of course, that are, continuing to steadily rise. And it's the slow and steady that wins the race. It's not the, massive market volatility and fluctuations that I'm sure you're used to in Boca and South Florida area, but I think in Oklahoma it's the slow and steady that ultimately wins the race. So I love Oklahoma City. I think it's a great market to invest in. There is an affordability moat right now in Oklahoma City with average apartment rents, for example, running around $1,000 a month, and that is less than 40% below the U.S. mean, right? So it's leaving a lot of good headroom for rent growth in the coming years.
Yeah, no, I love that. You got population moving up. Rents are on the right trajectory, which a lot of markets cannot say. And one of the cool things too is when you look at like the some of the fundamentals that really matter. Unemployment, obviously, you see the 2020 spike. That's nationwide. But then you see the regularity. I mean, sub 4% across the board over the last number of years. Population I mean, that's about as linear of a trajectory as you could possibly get. I mean, the population is increasing over time. And that is just, as an investor, you certainly don't want to be looking at certain markets that are obviously the inverse of this in certain communities on the West Coast. I mean, I just saw where, in Portland, one of the largest office complex, like they don't know what to do with it, and because people are just not there anymore, they're moving out. And so obviously Oklahoma City being on the right side of that. So what are some other things that people should be thinking about?
Yeah, I mean, some other things, of course, in terms of key investment metrics, and even before that, talking a little bit about the unemployment, which is directly correlated, and the population growth are both directly correlated to low occupancy and supply, right? So, or low vacancy and supply. So your occupancy rates are roughly 90 to 93% in Oklahoma City, and there's limited supply, which is making landlords taper off concessions and keep rents really steady. If you're focused on the Oklahoma City markets, you should be seeing cap rates anywhere between 6 and 9%, and leverage 12.5% price to rent ratio. Yeah.
That's incredible. That's absolutely incredible. And then obviously we've kind of spoken a little bit to the economic stability, but the jobs, right? Jobs matter. Job growth matters. The economy. I mean, look, it's the linchpin. It's the most fundamental metric that we could possibly consider. And so, as we're thinking about Oklahoma City, let's kind of carve out some areas. A lot of people are from out of town. They're from out of state. They're from out of the country. And so this is Oklahoma City, Oklahoma, right? If you've never looked at it on the map, this is what you're looking at. So let's key out some areas. So tell me a little bit about the village. Why should investors be paying attention to this area?
Yeah, I mean the village is a great area. I just actually listed a house in this area maybe 2 days ago, and I got a contract on it this morning in my inbox. And I should date this May 22nd, 2025. 48 hours later, we got a great offer on this property. Just one liner for the village. It's close to Whole Foods, and it's near like Nichols Hills, as you can see on the map. Solid B plus renters, easy value add, for cosmetics if you can find properties that are under market value.
Love that. And then we'll look kind of a little bit northeast in Edmond. So tell me, Edmond, Arcadia, what's new in those areas?
Edmond is great. Arcadia is awesome. I mean, you're going to find a lot of the, Thunder players kind of living in that area that's a little west of Edmond. It's in the Gaillardia neighborhood. Arcadia is also a very, very high-end area. Edmond itself is the highest household incomes in Oklahoma City. So, there's a great appreciation play here that you can use the IO products that we've mentioned earlier today. Class A, basically, it's a Phoenix suburb, basically. So great area to be in. Edmond can produce great rentals. A lot of people want to be in that area. There are good schools in that area and in those zip codes. So definitely don't overlook Edmond. It's one of my favorite markets. One of my good friends also lives in Edmond. So love it.
Fantastic. Very cool. And then Moore. So going south of the city.
Moore, yeah. So Moore is, I'd say, maybe 10, 15 minutes away from Norman, which is just directly south, which is where the University of Oklahoma is. Very large campus. We have OU football. Sports in Norman is just a huge thing. Moore generally was rebuilt post the 2013 tornado, which I was there at the time. Actually, I was in Guatemala, but I was living in Norman at the time. Moore's great, reliable cash flow, school driven for, long tenures. So, Moore is a good place to be in. And, a lot of people want to be in that school district specifically. So, they'll be looking for homes in Moore, to rent.
So do you get with Moore, do you get a little bit of diversification between a bedroom community to the Oklahoma City proper, plus a little bit of a bedroom community to Norman, as well as being kind of its own good school district? So you get some diversity there?
I would say the only real bedroom community in the greater Oklahoma region or Oklahoma City region is probably more west, past Yukon towards El Reno. I would say Moore is still very, very stable. Even Edmond and other areas like Midwest City and Spencer could be great places to invest your money. So I don't necessarily think that Norman, despite it being a college town, is strictly a bedroom community, because a lot of people like Norman just as a little town. I mean, in fact, Norman's one of my favorite towns in Oklahoma. And obviously I'm biased. I went to school there in college and I had great memories and built, wonderful relationships while I was at the University of Oklahoma. But there are still people who want to live in Norman full time.
I love that. Fantastic. And this is the kind of insights that you don't get unless you're with a market expert. So we'll cap out Oklahoma City by talking a little bit about Midwest City. So what's unique about Midwest City when you look at it compared to these other markets that we just highlighted?
Yeah. So one thing to consider in Midwest City, military clauses, of course, matter. You want to take that into consideration because you are in very near proximity to Tinker Air Force Base, which is in Midwest City. So, you have to take that into consideration. If you're investing in Midwest City, you're probably looking at about 8 to 9% cap rates. But, one other area on this map that we didn't really mention, and I don't want to overlook, is the Yukon area. And I know we haven't really pinned into it, but Yukon is also a wonderful area. Yeah, right there to invest in. A lot of great inventory by Rosh Coleman, D.R. Horton, which, we know Warren Buffett put $700 million into last year. A lot of great inventory coming up in Yukon. And, you can still buy homes that are sub $300,000. And, that's not something that you see every day, in today's, real estate environment nationally, right? $300,000 doesn't buy you much, but in Oklahoma City and in Tulsa and generally in Oklahoma, it could buy you a brand new home.
That's fantastic. I love that. So great look at some of these. What are there any other things that we should be considering when it comes to Oklahoma City before we move on? Any other thoughts about Oklahoma City that the listeners should be paying attention to?
Yeah, maybe an operational nugget, for people who are investing in Oklahoma City, when it comes to, say, evictions, for example, right? The timeline for evictions in the Oklahoma County in Oklahoma City is anywhere between 3 to 5 weeks, which to an investor is important. It's a market that does not have any rent control, and it's a free market, a true free market, which is also very important when you're coming in and you're putting your money. You want to know that your upside may not be capped because of government regulations or whatnot. So that's definitely something to consider, when you're investing in Oklahoma City.
Love that, man. Great insight. So now let's kind of take our attention and let's turn it towards Tulsa, right? The other major market there. And so a little bit different here, right? So we're going to talk more about, demographic trends. And so, what exactly does that look like as compared between Tulsa and Oklahoma City? What are the major differences that you think of?
Yeah. I think Oklahoma City is like call it your core plus sleeve, where you have lower beta with diversified employers and steadier absorption, whereas Tulsa is your enhanced yield sleeve with, higher gross returns, but, you have to underwrite, for supply surges in heavier and also heavier capex in like C minus stock areas. So Tulsa specifically, I'd say the theme, and this is what I'm personally doing in Tulsa, is long-term buy and hold. Ever since my grandfather was investing in real estate, I guess it was like from the early, call it 1970s. I wasn't born yet, but ever since then, Tulsa has been a long-term buy and hold market. And I think, it still holds true today. And I've seen people who have been buying real estate in the early 2000s, make a tremendous amount of return on their investment. So yeah, like you're showing here, strong demographic. I think we may have flipped these from the population, and I may have made a mistake here by sending you that, because Oklahoma City is like closer to the 1.4, and Tulsa is nudging towards just over 1 million in population in the metro, with also very low unemployment of 4.3%. So steady growth in the metro, and it's boosted by remote employers, remote employees who are coming here through the George Kaiser Family Foundation Tulsa Remote Program, which they give you $10,000 just to move to Tulsa if you have a remote job that is not within Oklahoma, that the employer is not within Oklahoma, and also tech companies that are now coming to Tulsa because of Atento Capital, Michael Bosch, GridX. These are venture capital firms. There's Aaron Sloan from the Engine Room, who created Golden Gloves VR, which is an awesome boxing virtual reality game that you can find on the Facebook Meta headset. So some things to consider.
That's incredible, man. I love that. So housing dynamics, what does this look like?
Rising rents. Yeah. So, really low vacancy rates of roughly 8%, rising rates of, roughly 4% quarter over quarter, with occupancy at like 93% in the Tulsa market. Fast turnaround time in terms of leasing. There is a little bit of a front-loaded pipeline right now. So, you want to prudently model 50 to 75 bips on extra vacancy through 2025 when you're underwriting your deals in the Tulsa market. Definitely strategic opportunities and leverage growth in tech and logistics sectors. So We see that every day. There's GetWit, and which is a wonderful company, and a lot of job growth here in Tulsa. Yeah, and I would definitely focus on areas with rent multipliers that are under 10x.
Love that. All right, so just like we did with Oklahoma City, we're going to take a little bit of a closer look into the Tulsa market. And so let's look at a couple of unique markets. Why don't you tell us a little bit about what's happening in these zip codes?
Yeah, I mean, you got that's kind of like the 74105 is Midtown. There are areas there that you want to be careful with. You definitely want to get with experts and, local people on the ground, because there are pockets of good and there are pockets of ugly and very, very bad. So, you just want to be careful and make sure that you're putting your money in the right places. In terms of 74114, you have the Gathering Place, which is George Kaiser and the George Kaiser Family Foundation put about $500 million into this park that won #1 best park in the United States. It is phenomenal. I mean, they have rebuilt the entire Riverwalk, miles and miles and miles of river walk that is just gorgeous. And I love taking my bike out there. And the Gathering Place is just an enormous park that's awesome and a great place to visit, walk around, work, open up your laptop. There are spaces that you can sit and hang out, coffee shops and restaurants and a whole bunch of things. So when we're looking at, Midtown, that's a hard place to invest in unless you can find stuff that is below market value. You want to look at value add. You want to consider appreciation and stability in that market. These are mostly 1950s types of homes, very walkable. And, if you can find something and buy it under market rate, some cosmetic work can yield a great appreciation and very high rents that are beyond $2,000 a month. In terms of the Gathering Place and that area, the more east you're going, the lower your rents are going to be, but everything is kind of like flocking towards the river and towards Midtown and towards Riverside and Brookside. Those are the areas that a lot of people want to be in, and it's tough to invest in those areas. It's just hard to find good inventory there.
Yeah, well, and that's why having a partner like you that has their ear to the ground and knows where to go. Because look, like you mentioned, good areas, bad areas, but the difference a lot of time can be just a couple of streets apart. And having that specific market knowledge to know where those streets are is of imperative importance. So,
I will say, sorry, if anyone's looking for an off-market opportunity, my friend Sophia is selling a house on 34th right near the river. And
there you go.
That 74105 zip code, I believe it is. It's a great flip. So you could do a fix and flip loan with you, Josh, or it'd be a great primary. It's currently being sold for, well, I shouldn't say because I don't really know, but it's an off-market opportunity. If anyone's interested, reach out. You're going to mention Jinx.
Yeah.
Jinx, great market to be in. The one word I would focus on with Jinx is appreciation. You've got riverfront retail. You've got new expressway, 5 to 7 year hold on properties in Jinx. Excellent school district. Everyone's flocking to that area to put their kids in the Jinx school district.
Love that. And then East Tulsa. What's different about East? So you got East and Midtown. I mean, what's the primary difference? They look somewhat close in proximity, Gathering Place to the Meadows. So what's the difference between the two?
Yeah, a little bit about East Tulsa. Great place to invest your money. A lot of new stock in that area in East Tulsa. You definitely can find, Rosh Coleman's that are renting for anywhere between $1,400 to $1,800 a month. East Tulsa is more of your blue collar workers blue collar demographic, hardworking folks who are, great people and, they pay their rent and, they may want to buy a house in the future themselves. So, that area is very safe, I would say. I love buying in East Tulsa. I hold some properties in East Tulsa, and I would not shy away from this area.
What are these Class C you would say
I
on
would
average?
say, it's Tulsa's a lot of pockets, so you got to really focus on the neighborhoods and on the street. But I would say you can find Class C, you can find Class B, and maybe even some, in this 74134 area zip code, you could even find A minus.
Okay, very interesting. And then the last within kind of the Tulsa metro, looking at Broken Arrow.
Yeah, I love Broken Arrow. I was just out there on Tuesday showing 4 houses to a client who's moving from Austin, which has become, in their words, a frothy market that they can no longer live in. And they bought their house in 2015, and they've like seen insane appreciation on it. And they're saying, "Oh my goodness, we can come to Broken Arrow, or Owasso or Jinx and Tulsa, and be closer to family and buy." Basically like a little mega McMansion, let's call it, on a half an acre or an acre. Broken Arrow is a wonderful market to invest in. A lot of new stock in Broken Arrow. Of course, the closer you are to the Rose District that you can see here on the map, the I'd say the better. It really also depends on the type of lifestyle that you're looking at. Rose District is the main street downtown of Broken Arrow where people want to be near, at least me for my kind of like lifestyle. But then people who want to be in a more rural area can go farther south towards the Coweta area. But really great places. It's a great suburb of Tulsa that, my one word for it would be growth. And, there's, top schools, low churn, great retention in terms of tenants renewing their leases, and it's ideal for a good little burr if you're trying to invest in Broken Arrow. What's not pictured here are a couple areas that I'll mention. Of course, there's Bixby, which is kind of like the in between Broken Arrow and Jinx, which I didn't mention. And then if you go north on 169, you would hit Owasso, which is also a wonderful market to invest in. And then where you see Gilcrease Hills on the map there, that just below that, just south of that, is actually where I put my money, and I play in that area. That's just like near north downtown. Downtown is that little cluster, like right where it says Tulsa. That is your interdispersal loop, that whole kind of square. That's bound by the highways, and within it is the central business district of Tulsa, Oklahoma. And if you can invest in any area that is in and around downtown, again, got to be careful of those pockets of good, pockets of bad. You could get great appreciation, great return. I'm putting my money in Emerson Heights right now, and working a deal with a builder and trying to buy a house which will come with a lot of land. And hopefully they're about 50% done with the house that I want to buy. And I'm pestering them every week, every couple of weeks, to try and get a contract on it.
Love that. So, and wrapping up Tulsa, are there any kind of final points that you'd like to make just about the market in general?
Yeah, Tulsa as well. Evictions run about 21 to 25 days. But the dockets get backed up around the holidays, so you have to plan for an extra month of vacancy in winter. That's kind of what I would say about Tulsa is great market to invest in, and great eviction timeline for investors, which it's important. No rent control, of course, in Tulsa as well. And there's a lot of growth happening in Tulsa, so the strategy long term, buy and hold.
I love that. And it sounds like, between both Oklahoma City and Tulsa, I mean, you've got anything that you're looking for. If you're looking for Class A, if you're looking for Class B, C, if you want to find flips, if you want to do some appreciation, some bursts, I mean, sounds like you got a little bit of everything. And so that speaks a lot to, the different types of investors that we see. And so typically investors will usually follow different types of avatars at different, points or times of their investment career. And so we'll kind of look at a couple of those now, and how, if you fit within one of these avatars, how LendingOne may have a product that could help you grow as an investor. And so that first bucket that we would put an investor in is the rehab specialist. These are people, Yoni, we're talking about that they love fix and flips. They want to get their money in and out as quickly as possible. And if you fall within this camp and you're interested in finding a lender that can help you with that, we would certainly love to help out. So we do have a fix and flip loan product. We interchangeably use fix and flip loan and bridge loan. These are short-term loans, typically between 12 and 24 months. The reason you may want to do this is, look, use somebody else's money. If you've got $100,000 in available capital, instead of dumping that all into one project, you can use that money and spread it across multiple projects. We can close really, really quickly on these. And so the cool thing is we will loan, if you find a fix and flip product. So let's say that you find a property for $100,000 that you can go in that clearly needs a lot of love. It's $100,000 to purchase. It's $100,000 to renovate. And you hope that after repair value, say $275,000, $300,000, then we will loan up to 90% of the $100,000 to purchase that property. So we'll loan up to $90,000 of the $100,000 to buy that property, but then we'll loan you the entire $100,000 that you need to rehab it. And what's cool about that is we're going to take that $100,000, we're going to put it in an escrow account. These are interest-only loans. There's no prepayment penalty on this, so you get in and out as quickly as you want, but we're not going to charge you any interest on those funds that you're using to renovate the property until you start to draw them down to pay for the renovations that you're doing. We can go anywhere between $100,000 and $5 million on the loan amount. And we can close these really, really quickly. The next avatar are people that, look, if you're watching this and if you're using Yoni and Keyrenter as you should be, then you're going to fall into this avatar of the long holder. You're probably buying and holding these for either the purpose of building long-term wealth or for a little bit of hedge against, the government wanting to take as much of your money as possible through the tax benefits of real estate investing. And if you're that type of investor, we also have a product for that. This is that DSCR loan. We compared it earlier to the DTI loan. This is the 30-year DSCR loans. And again, some of the advantages to that is we're using the property's income, not your personal income. There's no limit. So with the bank, once you hit 10, you can't use a bank anymore. And so with us, you can buy 5, 10, 100, 1,000. No difference with us. We have a lot of different flexible options with that. So for these, if it's a new purchase, or if it's a rate and term refinance, we can go up to 80% leverage on that property. Or if you're wanting to pull cash out of an existing property, we can go up to 75% loan to value on those cash out. These are all 30-year fixed rate. We do have ARMs available. They're just not really valuable in this particular economic environment. They're either the same interest rate or a little bit more expensive now for just reasons of what's happening in the market. As we mentioned earlier, we do have interest-only options. Now, one of the cool things about us is that we only have a 3-month seasoning requirement, meaning that if you've gone in, you've fixed something up yourself, and you've looked to put some value into it, we only need 3 months to be able to turn around and appraise that off of its existing comp. We can also provide deferred purchases or delayed purchases. So you might want to you need to buy something in cash really, really quick. But if you turn around and come to us, we can do what's called a delayed purchase and then pull that money, help you out, get your own money back out of that and then finance it for you. And then, as we mentioned before, no income or W-2 or tax return checks on that. You may be a capital cyclist. So this is somebody who's using the BRRRR strategy. As Yoni was mentioning, there's a lot of opportunity to find properties in and around both Oklahoma City and Tulsa to provide some additional value. And these people are wanting to continue. Look, the BRRRR strategy has been a tried and true method for a long time for many, many investors. And if you fit into that camp, we've got a loan for you as well. So the difference between this is really 2 loans. It is a fix and flip or a bridge loan. And then it's a 30-year fixed rate DSCR loan that we kind of marry into one product. We give you reduced origination fees on switching from the bridge loan into a permanent loan. So it's basically, you can kind of think of it like a buy one, get one half off in terms of the fees that are associated with it. But then again, you've got things like an appraisal, right? And everybody's got to pay for an appraisal. Appraisal might run you $500. Well, if you do the appraisal on the fix and flip, we don't need to turn around and comp your appraisal or we don't need to turn around and charge you for an appraisal on the back end. We're going to comp that for you. So you don't have to pay for an appraisal to get it flipped and for an appraisal to get it rehabbed. We're going to go ahead. And so we provide extra values like that, a little bit of a discount to the interest rate. Same thing with this. The idea is to get in and out of these really quickly. We can get the initial purchase to closing in as little as 10 days. Typically, these are 9-month loans, and then we can go up to 75% of the new property value of the back end on the ARV side. And then the next thing that I'm really excited to talk about is the avatar of the asset collector. So this is the investor who has been aggregating properties over a long period of time. And if you're doing that, you're probably looking to scale. You've started to see some cash flow. You're starting to look at your retirement, or maybe you're using this to be your primary strategy to build wealth in the short term and in the long term. And if that is your avatar, then Yoni and I have a treat for you today. And so we can use this. The way that a lot of these portfolio loans are used are either naturally in a new purchase or in a cash out refi. But if you're somebody who is thinking about purchasing a portfolio, Yoni actually has some contacts that we have reached out to, and we're going to share that with you here in just a moment. The advantage to the portfolio loans is you can close multiple loans in one property. So anywhere between, it's got to be a minimum of 3 properties or a maximum of 20 properties. You're going to get a discounted origination on these properties. And the cool thing is, as we talked about, you need a 1x coverage ratio for any DSCR loan. With a portfolio loan, you can use your entire portfolio of properties, because what we're looking to see is what are the total rents that you're going to get across 10, 12, 15, 20 properties, and then what are the principal, interest, taxes, and insurance. So what that means is that you can have 1 or 2 properties that technically underperform, so long as the portfolio at large performs at least a 1x coverage ratio. And then this is one origination process, one loan, one payment, the ease of use. I mean, if you've got 15 properties and you're having to keep up with 15 different loans, that can be a little bit of a headache. So we can provide that. Same terms as the regular DSCR. We can do, we have ARMs. All of these comes in 30-year fixed rate loans. We do have the same interest only. So if you wanted to put your portfolio into something that just cash flows, you're certainly welcome to do that. Same thing on terms of the leverage. So we go up to 80% on a new purchase or a rate and term refi. We'll go up to 75% on a cash out refi. So if you've aggregated 10, 12, 15 properties over the last 7, 8, 9, 10 years that have variable degrees of equity, variable interest rates on them, you can package all of those into one loan, do a cash out refi, pull money out of the entire portfolio to help you grow or move faster, or use that money for whatever you wish to do. Same thing, no income or employment verification. So now on to the good stuff. So Yoni, we've gone and you have gone and through a special offering have aggregated a couple of different properties into a potential portfolio. So we're going to sit here, Broken Arrow, which we were just talking about, one of those areas. And then more. So we're going to, before we get into the financial side of this, tell us a little bit about these properties.
Yeah. So thanks, Josh, for teeing this up. But, these are 3 houses, all owned by one investor who is looking to take their capital and deploy it into other opportunities that they currently have. One in Owasso, which, again, great market. I love Owasso. It's been growing. It has great stability, also good school districts. A good school district, and such as Moore as well in Oklahoma City, and of course that one house in Broken Arrow. At the moment, we are working on a make ready and to rent out the Broken Arrow house that is currently vacant. Both of the other 2 houses, Owasso and Moore, are currently occupied. And so this is an opportunity for someone to come in and, like I mentioned, get into both of these markets at the same time. Like I said, Oklahoma City is going to be your core plus sleeve, and Tulsa is going to be your high yield sleeve. And I think these are 3 great assets that could potentially make great investments for long-term buy and hold and appreciation purposes.
Yeah, I mean, look, there's not a lot of opportunities that you're going to have as an investor to get what will soon be a fully stabilized portfolio in a market where the manager is going to manage in both markets for. I mean, it's an incredible opportunity. So let's take a little bit of a look at the numbers. So the numbers themselves, we're looking at a purchase price of 645. Now, this is a special purchase price, right?
Yeah, yeah. So this is the portfolio price basically that we're only offering to people who are tuning in and listening to this webinar now or as the recording as we put it on our YouTube channel. So please mention this. If you add up, you can go on Zillow and look at these prices right now. And if you add up those prices, it will come out to a little more than that 645.
Yeah, fantastic. And then, as we mentioned earlier, we'll go up to 80% leverage on a portfolio new purchase. So you would need a down payment of about $129,000. Interest rates today are obviously, so this is as of today. So again, we do want to timestamp this. So this is May 22nd. Everybody out there is aware of what's happening in the interest rate environment. So interest rates could continue to go up. So this may be a good opportunity to take advantage. Or if you wanted to wait, maybe to see if interest rates are a little bit more favorable. But this is the opportunity as it sits today. These property types are all single family, and the combined rents between all three properties are right at $4,700. So here's the breakdown of the actual numbers. So your principal and interest under that 30-year fixed rate portfolio loan would be $3,489. Your combined property taxes would be $533, and your combined homeowners insurance would be $282 for a total payment of $4,304, which gives you a total debt service coverage ratio of 1.09, which again is going to be plenty for us to be able to originate on that loan. Now you can leverage up, so you can put more money down. It's obviously going to boost your cash flow. You can go in, and just so you know, the way that it works with LendingOne for all of our interest rates, our rates are determined by a matrix of the personal guarantor's FICO score and the leverage. So as leverage goes down, meaning you put more money down, your rate's going to come down. As your FICO score, your credit gets worse, rates are going to go up. So it's a dynamic field. But if you were to come in, if you've got good credit and you wanted to put 25% down or 30% down or 35% down, that rate's going to go down, 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 down. Debt service coverage ratio is going to go up, 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 and it's going to make that property cash flow a little bit better. Any thoughts before we move into the last couple of bits?
Yeah, I should mention I just looked it up. The Broken Arrow house, 520 West Roanoke Street in Broken Arrow, is actually renting for $1,650 now. So that rent should be $4,850 rather than $4,700. So your debt service coverage ratio, of course, will go up with a little bit more rent. And it's very interesting to see how sensitive it is that cash on cash is to small increases or decreases in the rent amount. So just something to consider as you're underwriting this and looking at this investment as an opportunity.
Yeah, no, I love that. And so we'll do a real quick phone math here.
Back of the napkin. Yeah.
Back of the napkin. So we'll go in, and then that would increase your debt service coverage ratio to 1.13. So so that makes that look even more attractive, even with rates where they are today. And that's what's cool about this is what we're trying to show is, hey, there's opportunities out there. And so, this is not only going to cash flow a little bit, but you're also taking advantage of these amazing markets that Yoni was just talking about and how they're going to appreciate over time. So certainly opportunity here. Love that you can provide this type of a portfolio for your investors, Yoni, and I would imagine somebody will certainly be taking advantage of this. So excited to see what happens with that. And then the last thing.
And that last question on that is, yes. These aren't on the IO loan product, right?
No, this is the standard loan product. So cash flow would be significantly improved if you were to go IO on. Yeah. Great point. Great point. So definitely reach out to Yoni if you have any interest. I'd imagine this property is going to move fast. I'm sure probably even clip out just this segment, maybe to share in some other areas to show how advantageous this could be. And then the last thing that I wanted to address in terms of the opportunities that we have is if you're buying infill lots in any of these markets within Oklahoma City or Tulsa, we can help you out. These are very similar to our bridge loans. So these are typically 12 to 18 month loans. This is ground up new construction. So we don't fund the horizontal. So we're not going to be able to fund the dirt. But once you're ready to go vertical with it, we can jump in and fund all of that. Reach out to us. We do these nationwide all day, every day. So if you got any interest, please let us know. And then just kind of recap, if you're interested, reasons you may choose LendingOne. One, we're an extremely stable source of capital. So I mentioned before, the average family office that may have $20 million, $30 million available at any given point in time, when that's out, and then you come to a loan, if they can't recapture that money, sometimes you might get hung up with a hard money person or with a smaller lender. We have got a massive, massive capital stack at our back. We have never had an issue with funding any loans. That's never going to be an issue on our side. I've been doing this nationwide, again, like I said, for over 10 years. And we've got a dedicated group of people that work with just investors all day, every day that we'd certainly love to help you out. And then if any of this, if all of this sounds interesting to you, if you just want to chop it up and talk real estate, this is Yoni's information. I know that he would love to speak with you. Obviously an expert in all things Oklahoma real estate and investing, having been an investor himself. He could probably, I'm sure he'd be happy to help you. If you're considering if you should be investing in this market versus another market, Yoni's going to be your guy to talk to. And then on LendingOne side, one of the things that we've done with Keyrenter is we've separated out a dedicated loan officer for you. There's no need to call in, talk to the LendingOne hotline. We've got great agents everywhere helping people with determine what type of loans best for them. But for you, we've got an individual, Scott Wolf is his name. He's been with us for a long time, been in the industry for a long time, originated many loans across the country. And if any of the products that we have talked about today, if that portfolio is of interest to you in purchasing that, if you have a property that might be in need of a DSCR refi, if you're looking to purchase a new property, want to do ground up new construction, reach out to Scott. His information is there on the screen. He is your dedicated loan officer, loan advisor, because of your relationship with Keyrenter. So when you reach out, just tell him that you heard about us through Yoni, and he will certainly take great care of you. So Yoni, what are some parting thoughts that you have for us, or some final words of advice before we jump off today?
I would say don't overlook Oklahoma as a place to put your money. If you're from out of state and you don't know the market, come to Oklahoma, come visit us here. We'll take you around. We'll show you our offices. You can meet with our team. We're happy to show you homes in person, virtually, and we work with all sorts of investors, and we can help buyers and sellers, and investors, from all over the world, invest in real estate. And Tulsa and Oklahoma City are both phenomenal markets to be in today. Tons of growth and potential to grow your portfolio. Stable markets, low unemployment, and high occupancy. That's what I want to hear when I'm investing in real estate.
Yeah, absolutely. Well, Yoni, thank you so much for your time. I really enjoyed doing this. I think everybody that's listening has got a ton of value out of this. I mean, this is really a deep dive into the two primary markets there in Oklahoma. If you have any questions, feel free to reach out. Yoni, myself, or Scott, we'd love to connect with you. We certainly appreciate you joining, and hope everybody has a wonderful morning, afternoon, or evening, wherever you happen to be listening. Thanks so much.
Thank you so much, Josh.
Thanks for listening to the Same Day Podcast. Tune in to a new show each week, and be sure to subscribe to get future episodes.